And at JP Morgan's earnings release, CEO Jamie Dimon was notably cautious, as has been his ilk of late, warning there has been some progress in bringing inflation down, but there are still multiple inflationary forces in front of us. Large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. Therefore, inflation and interest rates may stay higher than the market expects. But one of my next guests says he's seeing signs of deflation across the board and believes the Fed rate cuts are already too late. Let's dig into that with Paul Donovan, chief economist at UBS Global Wealth Management, and Jarrett Woodard, head of the Research Investment Committee at BofA Securities. Great to have you guys both here. Paul, I'll start with you because I do think Jamie Dimon's right about the long-term structural inflationary forces. Would you concede that as well, that the deflation is more of a near-term thing, or do you think it will become the predominant story for the next few years?
Well, I think Jamie is, at least on this occasion, wrong, as he has been on one or two occasions in the past. Essentially, when we look at the longer term, a country has the inflation rate that it wants. You choose the inflation rate that you want, you set the policy, you get the inflation rate that you want. But there's a lot of disinflation and deflation forces coming through. Aging populations are generally disinflationary. That's one force. Technological advance, increasing productivity, another force for disinflation. Localization of production as opposed to deglobalization is also potentially a disinflationary force because you make significant savings in terms of waste. So longer term, I see disinflation forces. And in the near term, across the United States, almost every sector has got deflation somewhere in the US.
So just quickly on that, you said why did you say localization could also be deflationary?
So localization is when companies choose to localize, to digitize their production, to produce closer to the customer base. And in doing so, you cut out an enormous amount of waste and other costs. So think about it. The ultimate form of localization, nobody buys a compact disc anymore. You download on one of these things, you stream, and the cost of entertainment and the cost of music has come crashing down as a result of us doing a lot less trade in the entertainment sector.
Interesting, although I'm not sure if that applies to kind of the economy more broadly, but you'd know better than me. One more quick point on this, as people, whenever they see the deflation word right now, get vehemently opposed to it. And I understand, because they say you can't bring out deflation until we've retrenched the price hikes that we've been through. And so I think you're talking about a different thing than most of the public thinks that deflation would mean. Are we ever going back to prices pre-COVID, or are we simply going to be talking about prices relative to their most inflationary COVID peak?
So it's a mixture. I mean, if we look at consumer durable goods have been collapsing in price. They're down over 5% from the peak. They're roughly at late 2021 levels. And yes, they probably will get back to pre-COVID levels. For other prices, people will mentally adjust. So the thing is, if let's say, you remember that a Snickers bar used to cost you $2 and now it costs you $3, you think $3 is an unfair price. And you keep thinking, actually, no, it should be $2. But after a year and a half, you sort of go through a mental reset. And then you start thinking, no, $3 is the fair price. So for some prices, we'll just mentally adjust. For other prices, like durable goods, which have been deflating for almost 2 years now, there you will see the prices probably going back to pre-COVID levels.
I think for me, the straw that breaks the camel's back, when the postage stamp goes to 73 cents, that's it, I'm done. It's over, start the insurrection. Not the resurrection. Jared, let me turn to you on that note. Listen, so you were putting out a note talking about whether you think this value rotation is for real or not. I don't know if you heard our last guest who was skeptical of that. But do you think this is the beginning of a final, long-awaited outperformance period we could see for value?
Yeah, Kelly, look, it's been a really rough couple decades for value investors. Are there any value investors left? If there are, my message to them is that, there's hope in the future. And it's for precisely some of the reasons that you and Paul have just been talking about. The past 2 decades, the average rate of inflation across G7 countries was about 2%. If you look over the past 100 years, though, the average was more like 5% inflation around the world. And I think it's very significant that this period of incredible underperformance of value investing versus buying growth stocks coincides precisely with this period of maximum deflation from rapid new technology, very optimal demographics around the world, rapid globalization, very low public debt levels, all forces, very disinflationary forces that, from our perspective, are rapidly reversing course in a structural way. I think Paul could be right about a short-term deflationary outlook. You could even see a hard landing in the United States, although that's not what we expect. But on a structural view, we think that we're in the middle of a shift from that 2% world of the past couple decades to the 5% world common over the past 100 years. And from a macro perspective, if you model that out, it's extremely bullish for value investing.
So you're talking about a 5% inflation in the world, so you're kind of in the Jamie Dimon camp.
Well, look, when you've got, I mean, we could talk about the supply side. Shipping costs are up 300% since the Red Sea last year, and that doesn't feed through to PPI released today until many quarters later. Apartment costs are rising again. At the government side, we're running a 7% deficit to GDP, the kind of thing you only ever see in history in the middle of a massive, war or massive recession. We've got record low unemployment, and we're running massive deficits as far as the eye can see. And I haven't heard a single analyst yet tell you that we're going to see, very much lower deficits after the election. So there's a lot of forces right now we haven't seen for the past 2 decades that, from our perspective, look inflationary or at least stagflationary.
All right.